Good morning, everyone. It's Friday, July 4th. Here on the East Coast, it's 10 a.m. And out west, well, you're just getting your day started at 7 a.m. We've got a really fascinating deep dive ahead of us today. It's packed with the latest financial news, some surprising market twists, and, what it all means for you, our listener, trying to navigate this ever-changing economic landscape.
Welcome to Zhuozheng Kaijing. We are committed to providing the most accurate, valuable, and timely information and analysis. Today, we're taking a really close look, at the intricate dynamics shaping global markets right now. We'll explore, pretty much everything, from the ongoing conversation around interest rates and tariffs, to some intriguing shifts in corporate strategies, and even what's happening, right on the ground in local economies across the globe.
Okay, let's unpack this then, because it really feels like we're watching two different movies playing out at the same time in the financial world. On one screen, you've got this, explosive wave of optimism, especially around AI, right? Driving stock markets to new, almost dizzying highs. But then on the other screen, there are these clear, almost contradictory signals, signs of caution, uncertainty, from shifting central bank stances to, surprising geopolitical stuff. How do we even begin to make sense of all this? What's the core story we should be focusing on as listeners?
That's exactly what we'll explore today.
Yeah.
Our mission for this deep dive is really to connect the dots. Connect the dots between those major economic indicators, the latest corporate actions, and even some, frankly, unexpected policy shifts that could significantly impact your financial landscape. We're going to dive deep into the why behind these headlines, moving beyond just the surface-level news to help you truly understand the bigger picture. Our goal is for you to walk away not just informed, but with a clearer sense of how these global forces might affect your own financial journey, empowering you to make more informed decisions. The deep dive. Global market dynamics, tariffs, AI, and rate cut speculation.
Let's jump right into the core of it then, these shifting sands of global markets. We've been hearing a lot about the U.S. stock market lately, and there's this particular buzz around August. Historically, what does August usually mean for U.S. stocks, and why do investors seem to get those jitters as summer goes on?
Yeah, that's a crucial starting point because, historical patterns, they often give us a valuable lens to view what's happening now. Looking back, say, over the past 15 years, August has this pretty consistent reputation. It's often a tougher month for U.S. stocks. The S&P 500, for instance, it's seen an average decline of about 0.4% in August, and actually it tends to get even tougher in September, usually an average drop of around 0.9%. So what this historical pattern tells us is that while summer often starts with optimism, August and September, they often serve as a kind of historical reality check for investors. It's a time when you might expect a bit more turbulence, not necessarily clear sailing.
Interesting. Okay. And I've heard about something called the fear index, VIX. Does that play a role in this August anxiety?
Oh, absolutely. The VIX, or the fear index, as most people call it, it's a crucial indicator. It shows investor sentiment, perceived market risk. It basically measures the market's expectation of future volatility, how bumpy the ride might be. And in August, historically, the VIX does tend to spike. Over those same 15 years, the VIX has risen by an average of, get this, 13.7% in August. That makes it the month with the highest average VIX gain.
Wow, 13.7%. That's quite a jump.
It is. It suggests that investors, while on average they become more nervous or anticipate bigger market swings as summer progresses. Now, one reason this might happen is simply fewer traders being active, summer vacations.
Yeah.
And when there are fewer participants, high-frequency trading, HFT, which is done by these powerful computer algorithms, it can amplify selling pressure more significantly. If large automated trades hit a market with, let's say, thin liquidity, it can cause sharper, quicker drops, almost like a ripple effect in a smaller pond.
In a smaller pond. Yeah, I get that. Okay.
Yeah.
So, given these historical trends, this pattern pointing toward a rockier August, should we expect August 2025 to follow suit? Or are current market conditions different enough to maybe break that pattern?
That's the million-dollar question, isn't it? While historical trends give us context, 2025 definitely has its own unique dynamics, things that could either reinforce or defy this pattern. On one hand, there's a strong underlying hope for U.S. interest rate cuts that traditionally supports stock prices, right? Makes borrowing cheaper, encourages investment. Many investors are genuinely banking on the Federal Reserve easing its monetary policy, maybe even as early as September.
Okay.
But on the other hand, you also have leading analysts warning about potential downside adjustments in the U.S. markets. A key event, something everyone will be watching, is Federal Reserve Chair Powell's speech at the Jackson Hole Symposium. That's in late August.
Right, always a big one.
Absolutely. If he avoids any mention of rate cuts, or if he sounds more cautious than the market expects, well, selling pressure could intensify quite rapidly. We did see a brief spike in the VIX above 20 after the recent U.S. jobs report. That hints at this underlying sensitivity to economic data, but overall it has remained relatively low, which shows that, a general optimism is still largely in play. So for you, the listener, this means August could be a month of, heightened anticipation, where every economic data point, every central bank statement, it just takes on this outsized importance.
Okay, that makes a lot of sense, especially tying it to Powell's speech.
Yeah.
Now, let's pivot a bit. Let's talk about Japan, because it seems to be telling a completely different story. Despite all this caution, these historical jitters in the U.S., the Japanese market has been on an absolute tear. What's fundamentally different over there? How are they defying these global jitters? It almost feels like that last buying opportunity some people are talking about.
It's truly fascinating to watch, isn't it? While the U.S. is grappling with August jitters and the VIX, Japan's Nikkei stock average, it's been nearing its yearly highs. And the TOPIX index, which is broader, represents more of the market, it actually surpassed the historic 3,000 mark for the very first time.
Wow.
Yeah. This midsummer surge in Japanese stocks, it can be largely attributed to what we call a short squeeze phenomenon. That combined with some underlying market stability factors.
Short squeeze. Okay, can you break that down a bit more simply? What does that really mean for investors and why is it so powerful?
Sure, absolutely. So imagine investors who are betting that a stock's price will go down. They short it. That means they borrow shares, sell them immediately, hoping to buy them back later at a lower price, return them, and, pocket the difference.
Got it. Betting against the stock.
Exactly. But what if the price doesn't go down? What if instead it starts to unexpectedly rise? These short sellers, now they're losing money fast. And to limit their losses or avoid even bigger ones, they're forced to buy back the shares they borrowed, often at higher prices.
So they have to buy, even if they don't want to.
Precisely. This forced buying creates more buying pressure, which in turn pushes the price even higher, trapping more short sellers.
Okay.
That's a short squeeze. It's like a coiled spring suddenly releasing, creates this rapid upward momentum. Now, in Japan's case, there was a fair bit of investor pessimism earlier in the year, so many people were shorting these stocks. But critically, the initial buying positions, meaning how much stock was bought with borrowed money, on margin were actually quite low. This meant there wasn't much panic selling when the market started to gain strength. This combination essentially trapped the short sellers, forcing them to buy, and that just intensified the rally. We can see this pretty clearly in the data. Margin buying balances, which indicate that speculative buying on borrowed money, they were quite low. As of early August, the credit ratio, that's the ratio of buying to selling on margin, was at 6.8x. That's actually the lowest it's been since March 2024.
Okay, so lower than before.
Yeah. And to put that in perspective, during previous downturns, like the Nikkei's big drop back in August 2024, this ratio was over 10x. That indicated a lot more speculative buying that could be forced to sell if things went south. The fact that the ratio of margin buying to the prime market capitalization is only around 0.37%, that's a low since February 2021. It means there are fewer forced sell-offs from margin buyers during declines. And that helps sustain the rally. It makes the climb more stable, less prone to sudden drops. It's a bit counterintuitive, actually. But sometimes less speculative demand can lead to a healthier, more sustained upward move because there's less overhang from forced selling. For instance, Nomura's leveraged ETF briefly dipped below a 1x credit ratio. That shows just how tough it became for those betting against the market.
So if I'm understanding this right, the less speculative money involved, the more stable the rise can be, because fewer people have to sell if things wobble. That really clarifies it. It's almost the opposite of what you might assume.
Exactly. It suggests this rally isn't just built on, risky leverage. And a great example of this is Fujikura. It's a company that's kind of symbolic of this trend. It's surged over 3% recently, hit record highs, driven by strong demand for fiber optic products, upward profit revisions, solid fundamentals. Its credit ratio was just 0.63x. That indicates active short covering from those who had bet against it, which amplified its gains. Analysts are, well, quite bullish on Japan for the rest of the year. Bank of America, they've revised their Nikkei target up to 43,000, and Daiwa Securities has even raised its forecast to 44,000.
Wow, big numbers.
Yeah. These forecasts are fueled by expectations of continued global liquidity and, importantly, those anticipated Fed rate cuts in the U.S. That tends to send capital flowing across markets.
Right.
The prevailing thought seems to be that if there's any dip, say in September, it might actually be seen as a final opportunistic buying window before a really strong year-end rally takes off. So for our listeners, this suggests that while U.S. markets might be navigating some August chop, Japan could offer a more consistent, though maybe somewhat overextended, upward path right now.
That makes a lot of sense. Okay, so we have this general optimism in Japan and even in the U.S., despite some jitters, especially around AI. But how are global markets just generally defying the very real risks of increasing tariff tensions? That seems like a big shadow hanging over things.
Mm-hmm.
And when we talk about abundant liquidity, what does that actually mean for, everyday listeners? Is it just a fancy term for lots of money floating around?
It's a powerful combination right now, truly. And it is currently dominant. The widespread stock market rallies we're seeing in Japan, the U.S., Europe, they're primarily being driven by what investors perceive as this almost unstoppable force of generative AI.
Right, AI is everywhere.
Exactly. This optimism around AI's transformative potential is just so strong right now that it's effectively overshadowing the very real risks posed by new U.S. tariff policies.
Yeah.
For example, SoftBank Group, a major player in AI investments, key holder of Armaments, it's been hitting daily record highs in Japan. In the U.S., just 10 AI-related companies,
Yeah, just 10.
Are responsible for over 80% of the S&P 500's incredible $4 trillion market cap increase since late last year.
80% from just 10 companies. That's staggering.
It is. Investors are seeing immense long-term growth potential in AI, and they're not just keeping their profits in U.S. tech, they're actually diversifying those gains into other sectors, other regions globally. And that's leading to this truly synchronized rally that feels almost immune to traditional headwinds right now. Now, regarding abundant liquidity, it's more than just a fancy term. It's quite literally a flood of available cash in the financial system, just eager to find a home in investments. Think of it like water filling up a swimming pool. When there's too much water, it spills over, flows into other areas.
Where's all this water coming from?
Several key sources. First, strong expectations for U.S. Federal Reserve rate cuts. The market is pricing in like a 90% chance of a 0.25% cut in September.
90%, that's high conviction.
It's very high. With more cuts anticipated in October and December, lower rates generally make borrowing cheaper, make bonds less attractive, and that encourages capital to flow into stocks. Second, other major economies are also easing. The European Central Bank, ECB, they've already cut rates 7 times in a row. China has significantly lowered its policy rates, too, to stimulate growth. So these collective actions by central banks worldwide are injecting vast amounts of money into the global economy.
So it's not just the U.S. Fed, but other central banks easing, too, creating this big, almost overflowing pool of money looking for a place to go.
Exactly. And this translates to real-world impacts. The combined M2 money supply of major economies, excluding Japan, is nearing record highs. It's sitting at an astounding $112 trillion.
Wow.
A significant chunk of this is what we call excess savings, money that isn't immediately being spent on, say, consumption or direct business investment, but is instead flowing into financial markets, like stocks, U.S. money market funds, for instance. They're basically reservoirs of idle investor cash waiting to be deployed. They've hit a record $7 trillion.
$7 trillion just sitting there.
Waiting for an opportunity. This immense pool of money creates a resilient market that, well, for now, seems able to shrug off even major risks like tariffs, because there's simply so much capital looking for returns. It's like that saying, a rising tide lifts all boats, right? Even those with maybe a few holes in them.
That's quite a lot of capital floating around. It paints a picture of overwhelming optimism, almost. But you mentioned earlier that this optimism could crumble.
Yeah.
What are the specific underlying risks that could really disrupt this AI-driven rally, especially thinking about those tariffs and, the always present ghost of inflation?
Well, yeah, despite the current exuberance, there's definitely an underlying fragility, a tension beneath the surface that we absolutely need to pay attention to. One major concern is the possibility of stagflation. That dreaded combination, right? High inflation and slowing economic growth.
Right. The worst of both worlds.
Exactly. The fear is that if companies are forced to pass on the full costs of these new tariffs directly to consumers, it could entrench high inflation, make it stickier. And that would make it much harder for central banks to cut rates and support growth without just reigniting price pressures. We're already seeing some maybe subtle signs of resurgent inflation. The U.S. ISM non-manufacturing price index, for example, hit a 22-month high in July, and the New York Fed's consumer survey showed 5-year inflation expectations rising for the first time in 5 months. Small tremors, maybe, but definitely worth watching.
Yeah.
This raises a critical question for you, the consumer and investor, who ultimately bears the cost of these tariffs. If companies pass them fully on to consumers, well, demand could certainly dampen. Everything gets more expensive. But if companies absorb those costs to stay competitive, their profit margins shrink. And that could lead to difficult decisions. Hiring freezes, cutting back on investments, maybe even layoffs. We've already seen hints of the labor market weakening a bit in the July jobs data. A slight uptick in unemployment claims. If the U.S. economy slows more unexpectedly, especially if unemployment rises significantly, that strong investor optimism we talked about, it could be forced into a pretty sharp sudden revision. Persistent inflation, coupled with fading hopes for aggressive rate cuts, that could very quickly reverse the flow of that abundant liquidity and lead to a much more challenging market environment. It's a delicate balance, almost like walking a tightrope.
Indeed, it sounds like a very precarious balancing act. Okay, so we have these concerns, but those persistent expectations of a September Fed rate cut, they remain a significant tailwind for the stock market. And this speculation just got an interesting boost, didn't it, with a new Fed appointment?
It certainly did, yeah. President Trump recently announced the appointment of Stephen Milon. He's the chairman of the Council of Economic Advisors, or CEA. He's being appointed as a new Fed governor effective August 8th. Now, Milon is widely expected to advocate for rate cuts. That aligns with President Trump's known preference for lower rates to stimulate the economy.
Right.
So this appointment could definitely reinforce the market's belief in a September rate cut, give equities a bit of a psychological boost. However, what's fascinating here is that the bond market, well, it's telling a slightly different story. It's reflecting those inflation concerns we just discussed.
Oh, interesting. How so?
While stocks are kind of cheering, the U.S. 10-year Treasury yield has recently risen to 4.28%. This increase is primarily due to those ongoing worries about tariff-induced inflation and also somewhat weak demand in recent bond auctions. Buyers weren't quite as eager as expected. We're also seeing some spillover effects in the European bond market. Yields are rising there too. It indicates a broad-based concern about inflation globally. So all eyes will be on the upcoming July CPI data release next week. That will be absolutely critical for assessing the true impact of tariffs on consumer prices. And by extension, it'll influence the Federal Reserve's future monetary policy decisions.
Got it. CPI next week is key.
Absolutely. It's also worth noting, just quickly, that the Trump administration is reportedly expanding its list of candidates for the next Fed chair. Names like James Bullard, Mark Summerlin are emerging, and Treasury Secretary Bessent is overseeing that selection process. This just adds another layer of political influence into future monetary policy discussions, making the Fed's path even less predictable.
Fascinating how all these pieces connect. Stock market, bond market, seemingly sending different signals right now. Okay, let's talk currencies for a minute. Despite some of these broader market shifts and that Japanese stock rally we discussed, why is the yen weakening? That seems a bit counterintuitive. And what's happening with gold? It seems to have been on a wild ride.
Yeah, the yen's depreciation is quite complex, a real interplay of factors, and it does seem counterintuitive given Japan's stock strength. In Tokyo's forex market, the yen recently declined to 147.3133 per dollar. That's down 51 sen from the previous day. A significant driver here is yen selling by domestic importers, especially ahead of the Obon holidays. They need to convert yen to dollars for the international transactions.
Okay, practical demand.
Right. Additionally, the very strength of the Japanese stock market, fueled by that rising investor optimism we talked about, paradoxically makes the yen less appealing as a low-risk or safe haven currency. When global sentiment is overwhelmingly positive and stocks are rising, investors tend to move away from lower-yielding perceived safe haven currencies like the yen. They favor higher-yielding or growth-linked assets instead.
So good news for stocks can be bad news for the yen in a way.
In this context, yes. The yen also fell against the euro for a third consecutive day, trading at 171.76 Haiti yen per euro. So it indicates a broader trend of yen weakness against major currencies. As for gold, yeah, we've seen some truly extreme volatility in New York gold futures recently. It initially surged above $3,500 per troy ounce, first time ever, but then it plunged pretty dramatically within a short period.
What caused that huge swing?
It was basically confusion surrounding U.S. tariffs on bullion, gold bullion. The U.S. Customs and Border Protection, CBP, initially stated on its website that COMEX-approved gold bullion would be classified as a tariffable, semi-finished product.
Ugh. That's a big deal for gold.
Huge! This contradicted long-standing market expectations that bullion would be exempt. It sparked a rapid rally as traders anticipated supply disruptions, higher costs, forcing short sellers to frantically cover their positions.
Okay.
However, later that very same day, reports emerged that the White House had intervened. They clarified that bullion would indeed retain its tariff-exempt status, and that immediately caused prices to fall back down.
Wow, what a roller coaster.
It really was a stark reminder of how sensitive markets are to policy clarity or lack thereof, especially with tariffs on commodities. For you, the listener, it just highlights how quickly market sentiment and prices can shift based on even temporary policy uncertainty. Let's turn our attention quickly to Europe. European stocks have shown a bit of a mixed performance this week, reflects a more nuanced sentiment over there. The Stoxx 600 index, covering 600 major European companies, was slightly up, maybe 0.2%, seemingly supported by those lingering hopes of U.S. rate cuts. However, other key indices, like Germany's DAX, saw a slight dip, maybe 0.1%, so not uniform conviction across the continent. Individual stock movements were quite notable, though. For example, Novo Nordisk, the Danish pharma giant known for its obesity drugs.
Yes, huge company.
Huge. Saw significant gains after its rival Eli Lilly had disappointing obesity drug trial results. Investors kind of flocked back to Novo Nordisk, reinforcing its market position. On the flip side, Munich Re, a major reinsurer, plunged by 9%. That was after it lowered its premium income forecast, signaling challenges in its core business.
Big swings for individual names.
Definitely. In the foreign exchange market, we've seen the euro and the British pound strengthen against the dollar. This is largely a reflection of that ongoing dollar selling pressure due to the U.S. rate cut expectations we keep mentioning. But what's truly interesting in Europe is the growing speculation that the European Central Bank, the ECB, might be halting its rate cuts, or at least pausing them.
Really? After all those cuts they made earlier, they might just stop now. What's causing this shift in thinking? And what does it mean for Europe's economy?
Exactly. It's potentially a significant pivot from the more dovish stance we've seen from them. Several factors seem to be at play. While the U.S.-EU trade agreement temporarily averted a worst-case tariff scenario, the whole back-and-forth nature of Trump's tariff policies has created ongoing uncertainty and internal divisions within central banks about how to assess the risks. Also, Eurozone GDP growth in Q2, it remained positive. That eased some earlier market pessimism about a potential recession.
Okay, better growth than expected.
A bit, yeah. And critically, inflation in the Eurozone has actually aligned with the ECB's 2% target, which might make further easing seem less necessary from their perspective. Plus, Germany's planned fiscal stimulus in 2026, that's expected to pump more money into its economy, support growth, further reducing the perceived need for aggressive monetary easing. Some analysts are even going as far as speculating the ECB's next move could actually be a rate hike in late 2026, which would be a dramatic turnaround.
A hike? Wow. Okay. That's a big shift.
It would be. We're also seeing a similar situation brewing in Switzerland. They led rate cuts earlier this year, but now face growing speculation of a halt. This general, maybe lack of confidence among central banks in their policy decisions is quite striking, especially with tariff policies fluctuating and their full economic impacts still unclear. We're even seeing rare dissent within the Federal Reserve itself. Two officials voted for a cut in their late July meeting. That kind of split hasn't been seen in 32 years. And the Bank of England's recent 0.25% cut, approved by a narrow 5-4 vote. It just highlights the intense dilemmas policymakers face, balancing inflation, growth amidst all this trade uncertainty. So as Europe's dovish stance recedes, we've seen the euro and Swiss franc strengthen significantly against the dollar and yen over the last 6 months. That reflects this policy shift. Ultimately, this week's market dynamics will really hinge heavily on that U.S. CPI data release on the 12th. It's seen as a key indicator for all major global markets. While Japan's Nikkei 225 is approaching its all-time high, there are definitely overheating concerns. But hopes for tariff relief and continued Fed rate cuts are buoying stocks, and a softer CPI number could provide even further lift. For you, the listener, this really means staying attuned to central bank statements, and key inflation data is paramount. Those are the levers truly driving market sentiment right now.
Corporate strategies, innovation, and performance.
That's a really comprehensive look at the big picture market dynamics. Let's zoom in a bit now, move from the macro to the micro. Let's talk corporate strategies, innovation, performance. Starting with a truly monumental piece of news from the construction industry. Taisei Corporation acquiring Toyo Construction for 160 billion yen. What makes this the largest M&A in construction history, and what's the deep strategic significance behind this colossal deal?
Yeah, this is indeed a landmark deal. Marks the largest merger and acquisition in the history of the construction industry. 160 billion yen, Taisei Corporation acquiring Toyo Construction. This acquisition will see their combined sales nearing Obayashi Corporation's 2.32 trillion yen. So it instantly places them among the absolute top players in Japan.
Huge scale jump then.
Yeah, massive. The strategic significance here lies in completely blurring the lines that have traditionally divided the construction industry. Historically, there's been this clear separation, right, between general contractors Zenecon, who handled diverse land-based projects like skyscrapers, roads, and marine civil engineering specialist Maricon, who focus on ports, harbors, offshore infrastructure.
Okay, land versus sea, basically.
Pretty much.
Yeah.
By acquiring Toyo, which specializes in marine engineering and critical defense projects like self-defense force runways, U.S. military base work in Okinawa Taisei is gaining crucial specialized expertise. And that profoundly complements its existing domestic focus and its overseas expansion efforts. This allows them to create powerful synergies in burgeoning areas like carbon-neutral facilities, coastal infrastructure protection, and perhaps most importantly, large-scale offshore wind projects.
Ah, offshore wind, that makes sense.
Exactly. Those demand both extensive land and complex marine construction capabilities. This consolidation is also happening against a backdrop of significant challenges in the Japanese construction market. The industry faces a shrinking domestic market demographics, aging workforce coupled with rapidly rising material and labor costs.
Right, familiar pressures.
Yeah. In such an environment, M&A becomes a key strategy, almost indispensable, really, to maintain competitiveness, expand capabilities, ensure long-term profitability. Taisei, already one of Japan's big five general contractors, they've been actively pursuing M&As since 2021 to expand beyond traditional construction. It's also worth noting the role of key shareholders here, like YFO, that's the Nintendo founding family's asset firm, and Afronio Holdings. Their previous attempts to acquire Toyo didn't go through, but their substantial stakes ultimately helped facilitate this deal, and directly benefited their shareholders' doubled stock prices since 2022 due to the increased acquisition premium.
Interesting backstory there.
Yeah. And Taisei's chairman Tanaka, he set this ambitious goal: expand the company's revenue to a 4 trillion yen scale through M&A and broader business model transformation. This acquisition is a clear, massive step towards realizing that ambitious vision, signals a future of even larger, more integrated construction projects.
That's a truly massive shift in strategy for what can sometimes seem like a very traditional industry, building a new foundation, literally. Okay, moving to the automotive sector, we have Toyoda Gosei making a bid for Ashimori Industry. Why is Toyoda Gosei consolidating airbag development with this, 17.9 billion yen acquisition? What's the driving force here in the safety sector?
Right, this acquisition, 17.9 billion yen takeover bid by Toyoda Gosei to fully acquire Ashimori Industry, where they already held a pretty significant 28.29% stake. It's all about consolidating leadership and future-proofing in the critical automotive safety sector. Toyoda Gosei's stated goal is ambitious: rise from its current third position to second in global safety device market share by 2030.
Okay, aiming high.
Definitely. They see automotive safety devices, particularly airbags, as a crucial growth area, driven by increasingly stricter global safety regulations, especially in commercial vehicles, and also rapidly expanding markets like India, where new safety standards are being rolled out. So the full acquisition allows Toyoda Gosei to completely integrate and enhance its technology development and production systems for airbags, other safety devices. This is particularly important as the market evolves. New tech like integrated seatbelt airbag systems, new sensor technologies.
Right, things are always changing.
Always. A significant strategic challenge for Toyoda Gosei historically has been its reliance on Toyota. About 70% of its revenue depended on its primary customer.
Big dependence.
Yeah. By fully acquiring Ashimori, they can leverage its expertise, its established customer relationships beyond Toyota, and its broader production capabilities to serve a wider range of overseas manufacturers. This diversifies their revenue streams, strengthens their global footprint. The 44% premium offered by Toyoda Gosei, well, it underscores their commitment and confidence in this strategic consolidation. And Ashimori Industry has expressed its full support for the takeover, seeing the synergy.
Makes sense.
So for our listeners, this really highlights a trend. Even in mature industries, companies are aggressively pursuing M&A to gain market share, access new technologies, and diversify their customer base in what's a very competitive global environment.
It sounds like a smart move to adapt and consolidate expertise. Okay, let's shift gears now to corporate earnings. Always gives us a pulse on different sectors, consumer behavior. We're seeing some really mixed signals from Japan's giants, from a postal service to a regional bank and a beloved game developer. What's the story with Japan Post, Yamaguchi Financial Group, and Square Enix? What do their varied performances tell us about the undercurrents shaping Japan's economy right now? Are there common threads or just isolated stories?
You're right, it's a real mixed bag. And it shows the diverse challenges, the opportunities across different industries. And often, these seemingly isolated stories do reflect broader economic undercurrents. Let's break them down. Starting with Japan Post. Their April-June net profit dropped 9% to 67.7 billion yen, largely due to two main things. One, a reduction in their holdings in Yucho Bank, which impacts consolidated profits. And two, significant losses from derivatives by their U.S. affiliate, Aflac.
Okay, financial factors mainly.
Right. But interestingly, their core postal and logistics business, after years of struggle, actually turned profitable, first time in 3 years. Reported a 400 million yen operating profit. This turnaround was partly thanks to a postal rate hike back in October 2024. Shows pricing power can make a difference.
A small bright spot then.
A small one, yeah. However, there's a significant headwind on the horizon. Japan Post Co., a subsidiary, faces a severe license revocation for about 2,500 trucks. This is due to inadequate driver health and alcohol checks. It's going to lead to increased outsourcing costs of 6.5 billion yen annually. That'll definitely weigh on future profitability and highlights regulatory pressures. So yeah, a story of core business recovery offset by financial market volatility and compliance issues.
Got it. What about the regional bank, Yamaguchi Financial Group?
Right, Yamaguchi Financial Group. They reported a 16% net profit drop to 9.6 billion yen for April-June. Now, despite a slight increase in loan interest, which is good, their funding profits decreased because of rising costs, specifically higher deposit interest they have to pay out to customers.
Ah, the cost of money going up for them.
Exactly. Their core business profit, a key indicator of their main operations' health, fell quite significantly, down 40% to 13.3 billion yen. They're projecting an 11% full-year profit decline. Indicates these challenges rising funding costs, squeezed margins are expected to persist. This reflects a broader challenge for regional banks in Japan. Interest rates, while still low, are starting to edge up, making their traditional business models tougher.
Okay, a tough environment for them. And Square Enix, the game developer.
And then there's Square Enix Holdings, known globally, right? Final Fantasy, etc. Their net profit plunged by a dramatic 55% to 4.8 billion yen for the April-June period.
Wow, 55%? That's huge.
It is, primarily attributed to slower performance in their big online games like Final Fantasy XIV, reduced user activity due to a lack of major updates or expansions during this specific quarter. Weaker merchandise sales based on their popular IPs also contributed.
So content cycle timing, basically.
Yeah, largely, yeah. But it wasn't all bad news. Their amusement segment, game centers, arcades, actually saw a healthy 19% increase in operating profit. Shows some bright spots.
Interesting. Arcades still doing well?
Apparently so in Japan. Despite this quarterly drop, they have maintained their full-year forecast. They expect an 18% net profit increase for the fiscal year ending March 2026. So they anticipate a strong rebound, probably from upcoming game releases. For our listeners, this tells us that even in a seemingly thriving digital entertainment market, content refresh cycles and specific game performance can have a huge impact, and that brick-and-mortar amusement still holds a strong appeal in Japan.
That's quite a varied picture. Highlights how different sectors face unique challenges, unique opportunities. Okay, shifting to finance and real estate now. Mizuho Financial Group is launching a green recovery fund focused on older buildings. Why target older buildings for energy-saving renovations? And what's the larger strategy here, especially with real estate investments apparently surging?
Yeah, this is a very forward-thinking, strategically smart initiative by Mizuho. Plays directly into that global ESG trend, environmental, social, governance. They plan to invest a substantial 200 billion yen over 5 years, starting fiscal 2025. Specifically in energy-saving renovations for used buildings, particularly those over 20 years old.
Okay, why the focus on older ones?
Well, the strategy is multifaceted. First, it cleverly addresses the rising construction costs that make new large-scale real estate development increasingly challenging and expensive in Japan. By renovating existing structures, they can enhance their value more cost-effectively than building from scratch.
Makes sense. Cheaper to fix up than build new.
Often, yes.
Yeah.
The key is to significantly enhance the environmental performance of these older buildings. Think strategic upgrades, replacing old, inefficient lighting with modern LEDs, installing more efficient HVAC systems, heating, ventilation, air conditioning, improving insulation.
Right, the green upgrades.
Exactly. Once these older buildings achieve higher environmental standards, better efficiency ratings, they become much more attractive to a specific, growing segment of investors, including REITs, real estate investment trusts, and especially large institutional players like pension funds.
Ah, the big money wants green buildings.
There's a strong, growing global interest from these investors in sustainable and ESG-compliant assets, driven by both regulations and, frankly, a genuine desire for impact investing. In fact, Japan saw a record 2 trillion yen in real estate investment in Q1 2025. Indicates robust demand for such properties, particularly those with a clear sustainability profile.
Okay, so there's demand waiting.
Definitely. Mizuho's first project under this fund is the acquisition of Osaka's Panasonic IMP building for about 50 billion yen. They're also partnering with energy-saving tech specialists like Takasago Thermal Engineering for these renovations, ensuring the upgrades are cutting-edge, effective. The genius here is also that if the fund achieves its energy reduction targets, Mizuho Bank will even offer loans with lower interest rates for those specific properties.
A nice incentive.
Yeah, it creates a powerful financial incentive for other building owners to pursue similar green investments. It's a strategic move, taps into both the critical sustainability trend and the strong investor demand for environmentally improved real estate, turning older, less efficient assets into valuable, modern, high-performing investments. For you, the listener, this signals a major shift in how real estate value is being redefined in this era of climate awareness and ESG mandates.
Japan's domestic economy and policy landscape.
That's a really smart way to address both environmental concerns and market demand, effectively recycling real estate in a way. Okay, let's dive deeper into Japan's domestic economy, the policy landscape. We've heard about the Financial Services Agency, the FSA, implementing new reforms for integrated supervision. What do these reforms actually mean for financial institutions and, crucially, for you, the consumer, especially with all the recent concerns about account security?
Right. These reforms by FSA Commissioner Yutaka Ito are quite significant. They're aiming for a more agile, proactive, effective regulatory environment for Japan's financial sector. The core idea is to integrate supervision and inspection. These were previously largely separate functions within the FSA.
Okay, bring them together. Why?
It means combining the routine checks of financial institutions with the enforcement arm that issues administrative penalties. The overarching goal is to swiftly address emerging issues like sophisticated cybersecurity threats, financial fraud by enhancing risk detection through comprehensive data analysis. Commissioner Ito specifically cited the Iwaki Shinkin Bank's 20-year fraudulent lending case as a stark reason for reflection. A clear demonstration of why this integrated, more holistic approach is absolutely necessary. It's about being proactive, not just reactive, catching misconduct and systemic risks before they balloon.
Okay, makes sense. More proactive oversight. How does this connect to consumer protection, especially with online accounts?
Well, this new framework intersects directly with a major ongoing debate, one that hits close to home for many retail investors: compensation for account takeovers at online brokerages. There's a clear misalignment between major online brokers, think SBI, Rakuten, Matsui, and the FSA's expectations, while traditional brokers typically offer full restitution for losses from unauthorized transactions.
Right, they usually make you whole.
Usually. These online brokers have announced they will only compensate 50% of losses.
Only half.
Only half. And there are even more granular nuances. For example, SBI and Rakuten might not compensate at all if only existing holdings were sold without new purchases. They might offer just a flat condolence payment instead. Matsui applies the 50% rule to both unauthorized buys and sales.
Wait, so if my online investment account gets hacked, traditional brokers give me all my money back, but online ones might only give me half or even less. Why such a big difference? And what's the FSA doing about this? It sounds like a pretty big risk for everyday investors.
That's precisely the point of contention. And yes, a critical risk for everyday investors. Online brokers have historically operated more strictly on a self-responsibility principle, often disclaiming full liability if a breach was due to, say, a customer's password being compromised, arguing it was the customer's job to protect their credentials.
Blaming the victim a bit.
Some might see it that way. While even 50% compensation is a step beyond their historical stance, the FSA has been pushing hard for full reimbursement, emphasizing investor protection as paramount. However, the FSA admits it currently lacks direct legal grounds to fully enforce 100% compensation terms across the board for all types of incidents.
Ah, so they can push but not mandate it.
That seems to be the situation. It's a crucial point of misalignment that's persisted despite ongoing negotiations between the regulator and the brokers. And the situation has become even more urgent, more visible, with the rapid expansion of retail investing in Japan, particularly due to the new NISA tax-free investment system launched in January 2024.
Right, lots more people investing now.
Exactly. The number of new accounts has grown 25% in just over a year, drawing in many first-time investors, with online trading now accounting for a substantial 37% of domestic stock transactions. The need for clear, harmonized, robust investor protection policies is more critical than ever. It highlights this philosophical divide, really, between newer online platforms and established regulatory practices regarding who bears the burden of cyber risk. For you, the listener, this means exercising extreme caution with your online brokerage credentials and being acutely aware of your specific broker's liability policies. Read the fine print.
Yeah, good advice. Okay, let's move from financial regulation to something perhaps more tangible, maybe even stomach-churning for some listeners, agriculture. Specifically, how Japan is tackling surging rice prices and this alarming decline in macro can production. What's the government's plan for rice? And what's behind the mackerel scarcity that's impacting so many?
Okay, on the rice front, a staple of the Japanese diet, of course, the Ministry of Agriculture, Forestry, and Fisheries, MAFF, they've just approved a fiscal 2026 budget outline specifically aimed at boosting rice production. This comes after officials openly admitted to, well, misjudging past supply projections, which directly contributed to recent overwhelcome price surges.
Oops.
Yeah. Prime Minister Ishiba has signaled a significant policy shift towards prioritizing increased output. Measures include actively promoting heat-resistant rice varieties, adapting to climate change, and adjusting government stockpiles to try and stabilize prices. However, there are lingering concerns within the ruling Liberal Democratic Party. They worry that simply expanding production without equivalent growth in exports could lead to future price drops, making producers anxious about their livelihoods. It's a delicate balance, ensuring food security versus producer profitability.
So they messed up on rice, admitted it, and now they're trying to fix it. Got it. What about the mackerel? I mean, I love my tinned mackerel for a quick lunch. What in the world is happening? Their production has been halved in just 5 years. It feels like an existential crisis for my pantry.
You're absolutely right to highlight the mackerel crisis. It's a very relatable concern, as mackerel cans are a staple across Japan. And the situation is indeed alarming. Production halved in 5 years. That's a dramatic drop, primarily due to a steep 40% decline in domestic mackerel catches over the same period. Makes it incredibly difficult for processors to get enough raw materials.
40% drop. Wow.
Why? On top of that, global import prices for foreign mackerel have doubled. Adds another layer of cost pressure. This extreme scarcity is forcing producers to shift to other products, like tuna cans or even rice and meat cans, just to keep operations going. The Japan Canned, Bottled, and Retort Food Association reported that 2024 saw the lowest canned and bottled seafood output in 72 years, largely driven by this mackerel decline.
So why the decline in catches?
Yeah.
Overfishing? Climate change.
It seems to be a complex combination. Environmental changes like rising sea temperatures, plankton shortages affecting fish migration, that's part of it, but also issues with Japanese fishing quotas that some argue failed to adequately curb overfishing in the past. To address this urgent need, there's a strong push for full-cycle aquaculture, basically farming fish from egg to adult in controlled environments.
Okay, fish farming for mackerel.
Right. A promising initiative is the Saba Ibaru project in Fukui. They aim to breed resilient, heat-resistant hybrid mackerel by crossing different varieties, hoping to create a sustainable domestic supply. This project, supported by 60 million yen in government funding, is crucial for ensuring mackerel remains a stable part of the Japanese diet. They aim to distribute these hybrid fry nationwide by 2028. It's a literal race against time and environmental shifts to secure a key food source. For you, the consumer, this means potentially higher prices for your favorite mackerel cans, or maybe shifting to alternative seafood products for a while.
Okay, good to know. Let's bring it back down to the ground level now. Talk about Japan's street-level economy, consumer spending. The latest data for July showed some interesting trends. What's the vibe on the street?
Yeah, The latest data gives us a direct glimpse into everyday economic life. The Economy Watchers survey, which gauges the street-level economy by surveying various businesses like taxi drivers, retailers, it rose for the third straight month. The current conditions diffusion index hit 45.2. That suggests a gradual recovery, hints at improving sentiment, driven partly by reports of high-value sales and also some optimism sparked by that recently resolved, if tense, U.S.-Japan tariff agreement.
Okay, so some positive signs. Any specific examples?
Yeah, we're seeing specific examples too. CoolBiz sales, that summer business wear designed for comfort in the heat, of a remarkable 120% year-over-year in some apparel stores. Also, increased buying of heat stroke prevention items reflects both the hot summer and maybe consumer willingness to spend on comfort, health. Even beer gardens are reporting more customers despite having to raise prices. Indicates a rebound in social spending.
That sounds broadly positive for the domestic economy then.
Yeah.
But what about the elephant in the room we keep touching on, the weak yen? How is that really impacting everyday goods, especially European products? Are people really feeling the pinch?
You're absolutely right to bring up the weak yen again, because it's having a very tangible, often painful impact on consumers' wallets, especially with imported goods. European luxury items, watches, fine wines, artisanal chocolates, and even daily staples like Italian pasta, they're becoming significantly more expensive. We're seeing price hikes ranging from, say, 3% for high-end Omega watches to between 6% and 17% for brands like Italian pasta.
Wow, up to 17% more for pasta. Ouch.
Yeah. This is directly due to the yen weakening dramatically against the euro and the Swiss franc. The euro hit 173.80 in July. The Swiss franc reached a record 186, makes those imports much pricier in yen terms.
Okay, so how are consumers reacting?
This currency weakness is forcing a noticeable rapid shift in consumer behavior. Shoppers are increasingly opting for cheaper, often domestic, alternatives. For instance, supermarket data shows sales of European wines dropped 8% year-over-year, while domestic products only saw a 4% decline.
Clear shift there.
Very clear. It indicates consumers are actively choosing less expensive local options, or in some cases just cutting back on European imports altogether. With real incomes shrinking due to inflation and the weak yen eroding purchasing power, this trend of consumers trading down or foregoing imported goods is likely to worsen if the yen stays weak or weakens further against these key European currencies. For you, the listener, this means a daily reminder of global currency dynamics every time you shop for groceries or consider buying that imported treat.
Definitely something hitting close to home. Okay, moving on to another key policy discussion. There's this significant debate in Japan about abolishing the provisional gasoline tax surcharge. Both sides seem to agree on getting rid of it, but you mentioned it's complex. What are the main challenges? Why isn't it straightforward?
Right. While both ruling and opposition parties generally agree on abolishing it by year-end, there are three key challenges that make it quite complex, like trying to untangle a giant ball of yarn without making a bigger mess. First, the major issue, replacing the roughly 1 trillion yen in annual revenue this tax generates.
1 trillion yen. That's a big hole to fill.
Huge. Compensating for this massive loss might require other tax hikes or maybe reduce tax benefits elsewhere. That could easily spark public backlash or put pressure on other public services. Second, there's the nuanced question of the diesel tax. While gasoline tax abolition is prioritized, the diesel tax, which brings in 500 billion yen annually entirely for local governments, remains undecided.
So it affects local funding directly.
Exactly. Abolishing it would severely hurt local finances, potentially impacting essential community services. But keeping it while cutting the gasoline tax might seem unfair to diesel users, and it could even lead to this unusual price reversal where diesel actually becomes more expensive than gasoline. That would be very disruptive.
Tricky. What's the third challenge?
Finally, there are significant transition risks. A sudden abolition would significantly lower prices overnight. That could cause consumers to delay purchases beforehand, waiting for the cut, then lead to demand spikes afterward, creating supply chain disruptions.
Right. Everyone rushes to the pump.
Yeah. And gas stations would also need complex, timely tax refunds for inventory they already bought at higher tax rates. That's a big administrative headache. The opposition has proposed a gradual increase in current subsidies instead of an abrupt cut, but that would require significant additional funding. It's a really delicate balancing act, offering public relief versus maintaining fiscal health, with real-world implications for everyone who drives.
Definitely sounds complicated. Okay, let's round out our look at Japan's domestic scene with some interesting initiatives focused on human capital and community development. These show how different parts of society are adapting. What's happening there?
Yeah, some really interesting things. First, the Ministry of Health, Labor and Welfare, MHLW, is implementing this alumni reemployment initiative. They're actively seeking to rehire former staff who had previously resigned from government service, recognizing the immediate contributions these returnees can make.
Bringing back old hands, basically. Why?
Unlike new hires from the private sector who often need time to adapt to the unique culture of Kasumi Gaseki, Japan's bureaucratic-centered government alumni can often hit the ground running. They have existing knowledge, existing networks. For example, there's Kazuhiro Morita. He returned after working in healthcare startups, and now he's contributing directly to promoting e-prescriptions. While challenges like rank disparities for returnees with longer gaps still exist due to current regulations, the National Personnel Authority is supporting simplified rehiring processes from fiscal 2026. It's a significant shift, aims to address talent shortages, inject new vitality, diverse perspectives into the bureaucracy.
Interesting approach. What else?
Then we have the Ministry of Agriculture, Forestry, and Fisheries again, but this time focused on rural revitalization through innovative partnerships. They're launching a project to link local governments with private firms that possess advanced expertise. Imagine companies like Taimi, that's a platform for temporary job mediation connecting rural farms with needed labor. Or Sagri, which uses satellites for farmland analysis, helping farmers optimize yield.
Using tech to help rural areas.
Exactly. The goal is to boost agricultural productivity and sales, create replicable models for rural revitalization nationwide. MAFF will act as a bridge, helping clarify local needs, connecting them with corporate expertise, aiming for mutual profit growth. This is especially crucial as rural communities face huge challenges like labor shortages, demographic decline. For our listeners, it highlights how tech and flexible labor models are being deployed to tackle fundamental societal challenges.
Very cool. What about financial literacy and innovation?
On the financial literacy front, Saitama Rizona Bank is hosting a wonderful Kids Money Academy for elementary students. It's an experiential class, includes a bank tour, even a photo session with 100 million yen in banknotes, which I'm sure is quite a hit with the kids. Leaves a lasting impression.
A photo with 100 million yen. Sign me up.
Right. It's part of broader financial education initiatives, helping teach children about money management, savings, even crime prevention from a young age. Related to this, we see innovation hubs getting crucial support. Sun Precision Chemical Engineering Research Institute made a 50 million yen donation to Shibusawa MX, Saitama's innovation hub. That was facilitated via Musashino Bank's private placement bond. It directly supports local startups, fosters innovation, shows how financial institutions can facilitate crucial community development beyond just lending.
Good to see that support happening. And parasports.
Finally, yes, in Tokyo, the metropolitan government has launched Team Beyond ParaConnect. This is a free online platform specifically designed to match parasports organizations with supporting companies. Aims to boost sponsorships, provide much-needed training venues. Especially important as Tokyo prepares to host the 2025 Deaflympics. The initiative seeks to ensure lasting support for parasports beyond just major events, fostering a more inclusive, supportive society for athletes with disabilities.
Geopolitical and regulatory undercurrents.
That's a truly comprehensive overview of what's happening on the ground in Japan, from big industry shifts to daily life and community initiatives. Really fascinating stuff. Now let's broaden our lens one more time. Let's look at those geopolitical and regulatory undercurrents, which, as we've seen throughout this deep dive, often have a direct, profound impact on markets. Let's delve a bit deeper into the Japan-US tariff negotiations. What can you tell us about what really went on behind the scenes in those incredibly intense talks?
Yeah, those negotiations, which eventually led to that temporary resolution on July 22nd. They were incredibly intense, stretched over 3 demanding months. Minister Akasawa, Japan's economy minister, made an unprecedented 9 visits to the U.S. for these talks. That alone highlights the critical nature of the situation and the lingering tensions that persisted even after the agreement was publicly announced.
9 visits.
9 visits. Reports from insiders suggest President Trump used these talks, particularly at the G7 summit, as a kind of show of strength, vocally defending U.S. high tariff policies while negotiating directly with world leaders. It was a very public display of leverage. A fascinating detail from behind the scenes involved Toyota, one of Japan's most iconic companies. Chairman Akio Toyoda reportedly handed Prime Minister Ishiba a powerful negotiation card, a bold proposal to import U.S.-made Toyota vehicles to Japan.
Import U.S.-made Toyotas into Japan. That's surprising.
It is. It demonstrated a concrete willingness to support U.S. manufacturing interests, create jobs in America, potentially easing some of that intense pressure on the automotive sector, which was a major point of contention. Despite the agreement, however, discrepancies soon emerged between the official explanations from both countries regarding the details, the scope of the resolution, underscoring that not all issues were fully resolved or interpreted identically. Minister Akasawa's recent 9th visit after the agreement highlights this continued need for clarity, adjustment, suggests the temporary resolution is still very much a work in progress.
So, still ironing out the details, what about the specifics on tariffs? Like semiconductors or cars?
Right. On the specifics, Japan has been reassured of most favored nations status for potential tariffs, meaning it won't face worse rates than other countries. For instance, while Trump initially announced roughly 100% tariffs on all semiconductor imports, the U.S. later agreed with the EU on a more palatable 15% rate. That's now expected to apply to Japan as well.
Okay, 15% is better than 100%.
Much better. However, the exact timing for implementing agreed tariff reductions on automobiles and auto parts between Japan and the U.S. still surprisingly undecided. Minister Akasawa referenced the 54-day U.S.-UK implementation timeline as a benchmark, urging the U.S. to swiftly amend its tariff reduction order to bring certainty. He also discussed mutual tariff reductions with U.S. officials, but significantly, could not explicitly confirm whether U.S. tariffs on semiconductor manufacturing equipment for Japan would be zero, unlike the EU's reported zero tariff agreement with the U.S. on that.
So still some uncertainty there for key equipment.
Exactly. It points to the complex, ongoing, somewhat asymmetric nature of trade relations under the current U.S. administration, where some allies might get more favorable treatment than others, leaving Japan still in a state of watchful waiting on certain critical industries.
That sheds a lot of light on what was happening behind those closed doors. Sounds like trade negotiations are less about signing one document and more about ongoing diplomacy and adjustment. Okay, lastly, let's talk about this anti-ESG movement in the U.S. What exactly is this movement, and what are these proxy advisors that seem to be at the center of the backlash? It sounds like a real battle brewing in the world of corporate governance.
It truly is a battle.
Yeah.
And one with significant implications for how companies are run, how capital gets allocated. The anti-ESG movement in the U.S., well, it's a growing political backlash, largely from conservative circles, some prominent business leaders. It's against the increasing emphasis on environmental, social, and governance ESG factors in corporate decision-making and investment.
Okay. Why the backlash?
Critics argue that pushing ESG agendas distracts companies from their primary fiduciary duty, maximizing financial returns for shareholders. They contend these factors are often driven by ideological rather than purely financial motives, or that they're being used to push a specific social agenda. At the heart of this controversy are proxy advisors. These are specialized firms like Institutional Shareholder Services, ISS, and Glass Lewis. They provide detailed research and voting recommendations to institutional investors. Think massive pension funds, mutual funds, asset managers on how to vote on shareholder proposals, board nominations at company annual meetings.
Okay.
They analyze everything from executive compensation, board diversity, to environmental impact, social policies. Then they issue recommendations. Vote for, vote against.
So they essentially advise these huge investors on how to vote on, well, everything from climate policies to executive pay. Why are they being called a cancer by someone as powerful as JP Morgan CEO Jamie Dimon? That's incredibly strong language.
Exactly. They were supposed to help these institutional investors, who might hold thousands of different stocks, make informed decisions on complex governance issues, especially given the sheer volume of proposals they face. However, critics like Jamie Dimon argue these proxy advisors wield far too much influence, particularly through what some call robo-voting, where institutional investors allegedly follow their recommendations blindly without doing their own independent analysis. Dimon famously likened them to cancer cells infiltrating corporate governance, arguing they push agendas not always in the genuine best interest of shareholders or the long-term health of the company. Texas, for instance, has even enacted a new law requiring proxy advisors to provide detailed financial analysis if they recommend opposing company proposals based on non-financial ESG factors, trying to force a financial justification for their ESG advice.
Interesting. So what's the defense from the proxy advisors themselves?
Well, on the other hand, proxy firms vehemently defend their role. They state they provide crucial independent insights that help institutional investors fulfill their fiduciary duties, which means acting in the best financial interest of their clients. Organizations like CalPERS is one of the largest pension funds globally, and the ICGN, a global network of institutional investors. They argue that excluding or diminishing the role of proxy advisors would actually harm corporate governance by limiting the independent information available to investors. They emphasize the final decision always rests with the investors themselves, and that these firms provide a vital service in a complex market. This whole debate truly highlights the fundamental tension, doesn't it, between a company's financial performance and its broader societal responsibilities, and how different stakeholders interpret and prioritize those roles in the modern economy. For you, the listener, it really reveals a fundamental ideological clash about the purpose of corporations and the role of investing itself. Outro.
Wow, what a deep dive into this intricate web of global finance and policy. From the market's AI-fueled surges to the yen's curious movements, critical policy shifts in everything from construction to agriculture, even how we define corporate responsibility. It's clear there's just so much more beneath the surface than the headlines suggest. If you were sitting down with a long-term investor right now, what's the single most important takeaway from this entire conversation? The one thing you'd want them to keep in mind as they navigate their own financial decisions in this really dynamic environment?
That's a great question. If we connect all this back to the bigger picture, what stands out most, I think, is the increasing interconnectedness and, frankly, the inherent volatility of our global economy. Expect continued shifts, especially as interest rate expectations and those complex tariff policies evolve. They often create these contradictory signals we've been talking about. What's fascinating right now is that while the market seems to be shrugging off many risks fueled by that abundant liquidity, the immense optimism around AI, the underlying concerns hasn't vanished. Concerns about inflation, potential economic slowdowns, they remain critical factors, factors that could shift market sentiment very quickly, very unexpectedly. So this raises an important question for you, our listener, as you consider your next steps. How will you position yourself? How will you position yourself to both capitalize on the exciting transformative opportunities in growth areas like AI, like green investments, while simultaneously building resilience, protecting yourself against the uncertainties, the economic crosscurrents that are still very much in play? Understanding these dual dynamics, the excitement of growth and the undercurrents of risk, that's really key to informed decision-making in today's markets. Thank you for tuning in to Zhujiang Kaijing. We are committed to providing the most accurate, valuable, and timely information and analysis. Until next time, stay informed and think critically.